Go ahead, David.
Hello and welcome to this 2020 Innovation Group webinar session, where today we'll be looking at developments in IFRS. If you are routinely reporting under IFRS, you will have probably already appreciated that the period 2018 into 2019 is going to be a period of some quite considerable developments. The last few years have been relatively quiet. So as we've gone through 2015, 2016, the last 2 or 3 years, there have been relatively minor developments and changes. But in 2018, there are definitely 2 significant new standards which need to be incorporated with new disclosures and recognition and measurement rules, those being the new standards on revenue and the updated standard on financial instruments. And then following that, hot on the heels in 2019, is the new standard dealing with leasing, which again is going to be a considerable change for just about everyone reporting under IFRS. And also a new standard looking at tax provisions. Well, it's not a standard, it's an interpretation, but that one is also causing some concern already in terms of how far we go. Not surprisingly, those 4 topics will be my focus for this session. First, to give you the overview of what's happened. Only one new IFRS in the last 24 months. That was IFRS 17, which deals with insurance contracts. We did do a specialist webinar on this earlier in the year, and it is really for specialists. If you're acting for insurance companies, and particularly if you're acting for those who provide long-term life insurance, then that standard is going to be a big impact and change for you. For most of the rest of us, and certainly if you're not a regulated insurance company, if you just use insurance in your day-to-day business risk management by taking out insurance policies, nothing's going to change. One new interpretation, as I mentioned, there is interpretation number 23, which is about reporting uncertainties in your income tax positions. It is an interpretation, which obviously means there have been different treatments which they're trying to resolve. Of the other key developments, the last really big change we've had to contend with was when IFRSs 10, 11 and 12 were released, but that was now 3 or 4 years ago. So other than that, we've been in this kind of build up to these 3 new standards, and those are IFRS 15, 16 and 9 as listed. Now actually, once you're up to speed with these new standards, in terms of what is coming down the, what are the kind of major additional projects and developments, well, there's only 3 accounting standard projects. There's going to be one dealing with management, one dealing with management commentary, which is really focusing on all of these narrative statements and the other kind of management review of the more qualitative disclosures. There will be a new standard dealing with primary financial statements. I mean, we haven't had anything new on that for nearly 10 years now, and just redefining what is the purpose of those main statements. And then also very specialist, a new standard dealing with rate regulated activities. So we've got the stopgap standard on that, which is IFRS 14. But if your charging system is set by the government, then there will be a new kind of more comprehensive standard. But other than that, we are really looking at the next 2 or 3 years, just getting these new standards incorporated into our reporting. There's a few other projects as well, just to be aware of, more guidance coming down the track on things like prior period adjustments, accounting estimates and correction of errors. I am starting to get quite a few questions from people about the whole management of when do we have to actually go back and correct an error by reopening last year's numbers. And obviously admitting that there is an error, if it is either yours or if it is part of the management of the company's error, then that is always a sensitive issue. But obviously the main projects are the ones as mentioned. So what is new for 2018? Definitely, and this is accounting periods starting on or after 1 January 2018. So the first reporting periods when we will be contending with this new guidance will be 31 December 2018 year ends. So we've got IFRS 15, accounting for revenue from contracts. It's the first year of adoption. We've had a number of years to get ready for this. It's been an issue for now 4 years, but obviously until it is applied new for the first time, there is always this sense of maybe uncertainty that it's been fully interpreted properly. IFRS 9 on financial instruments, again, it's been in the public domain now for 4 years. We've had time to prepare. If you are a financial institution, if you're a bank, if you're a regulated insurance company or fund manager, you need probably way more than just a 1-hour webinar. If you are just really a more standard commercial organization, IFRS 9 is going to be more refinement and evolution rather than a big revolutionary change, but I'll come back to that later. The other thing to consider for 2018, although maybe it's a bit late now, with the new leasing standard IFRS 16, you've got the option, if you want to adopt it in the same year as 2015, as IFRS 15. You can just do both new standards in the same year. Now, obviously, what that would do is accelerate the adoption of IFRS 16 because it doesn't become compulsory until next year, 2019. Obviously, what it does do, though, is it deals with all 3 new standards in one project and one exercise. So you might find actually managing the information, and as particularly IFRS 15 and 16, they have alternative transitional rules. You might find it easier just to manage the message being reported or manage how it would work for tax if you just tried to get it all resolved in the 2018. What I'm hearing now increasingly, most people taking the view that actually for the leasing standard, we're going to take as much time as possible to prepare. So most people, I think, will be waiting until they get to 2019 and then be going through the steps. So that's what is currently in place. What does this leave as not yet compulsory? Well, as I mentioned, IFRS 16, not yet compulsory. The insurance contracts, you've got another 2 years after that. The uncertainty in income tax positions also comes in from 1 January 2019. So the focus for the remaining 45 minutes or so of this session, what is going to be new and compulsory for 2018? Certainly the focus on revenue recognition, then a focus on also financial instruments, and then these other 2 key standards, IFRS 16, IFRIC 23. So finally, the previous international standard dealing with revenue, I think, was first issued in something like 1986. So to say that it needed updating was probably a simplification. It was just really not fit for this time anymore. What that meant was a lot of people, I don't know if you went down this route, but if you were reporting under IFRS, if you had things like a tech company providing software services, if you had something like an outsourcing company providing, I don't know, facilities for the government, a lot of the guidance that people turned to came from US GAAP, from US generally accepted accounting practice. The problem with US GAAP is it was potentially not always consistent with the IFRS framework. And also there was a considerable amount of guidance. Some of it was conflicting guidance. So what the Americans, together with the IFRS, decided was to put together this one new, consistent, comprehensive standard, and that is IFRS 15. Now, the core logic behind it, actually, I don't find anyone who can really take against this basic structure, because what it says is step one is you identify your contractual arrangements with your customers and identify within those what is the real commercial nature of the agreement. Now, obviously, that then asks the question, well, just how robust, how up to date, how accurate are your contracts you have with your customers, or your, if you're in practice, your clients' contracts? And they might have, you know, considerable terms and conditions in there, which maybe the lawyers have suggested. You know, I think if you've downloaded any kind of app from one of the big tech companies, we know we kind of click on that you accept their terms and conditions, which are all part of the contract. But what you're going to have to do is identify what are the real commercial elements of that. I mean, I know from my part, my contracts are probably about as simple and as straightforward as they can be. You know, I agree the date, I agree the rate, I agree the content of what's being delivered, and that's it. So you're first going to have to look to see if there are contracts. The American approach on this is there should be a persuasive evidence of an agreement, which does mean if there is no formal contract you can refer to, well, it should, or it could then be challenged whether you should be recognising any revenue at all, because you have no contract. Now, having identified the contract, what you then have is step two within that contract, especially identify performance obligations. So you identify these performance obligations, your contractual obligations, the services, the goods to provide. The only thing to appreciate is that one contract may contain multiple obligations. And again, you know, we've all seen the kind of package deal you can get, even a kind of summer holiday where they offer the flights, the hotel, the transfers, various excursions. That has multiple performance obligations. What you might also find, though, is that a number of separate contracts, maybe the lawyers have kind of divided it down, but it does add up to one single performance obligation. So step two, you strip out from those contracts the performance obligations. Step three, you determine the transaction price. Now, in a number of contracts, the transaction price is going to be very simple. It's going to be very straightforward. It's going to be just the invoice value. Obviously, more of an issue is if you have things like contingent elements, if you have deferred elements of payment, if there are rebates, if there are refunds, all of which means that we're looking at determining a value based on the market fair value rather than just the kind of invoice stated terms. What you must then do is allocate that transaction proportionately across the performance obligations based on the fair values of each of those obligations as a standalone delivery. And then the final step, you recognize the revenue in your net income as you satisfy your performance obligations. So again, here we'll be looking at the standard process. You know, if it is a service, you've actually delivered the service. If it is goods you're providing, you've delivered the goods. Now, this is where I think a number of people get slightly anxious with these new form standards, because what you then have on each of these 5 points is considerable implementation guidance. There is going to be a lot of examples, a lot of illustrations, and that just adds to the concern that when you're looking at any particular issue, have you followed the guidance expected? Now, when this standard was first discussed, when people saw the final standard in 2014, what they questioned was, well, there's 3 things particularly which are of concern. When it was talking about separate performance obligations, it referred to obligations which were either separable or were identifiable. And then the question was, well, which one prevails? Does it just have to be something which I could buy from someone else? Or does it just have to be something which can be identified within the contract? So if it's things like, a holiday, well, I could buy the hotel from someone else, but it is identifiable in the contract. We have had further guidance on this. And in essence, the guidance is you look at it from the customer's perspective. Now, that is a simplification, but you look at all of these questions from the customer's perspective. What is it they consider as the performance obligations? Second issue, are you acting as a principal? So is it your goods, your services which you're performing, or are you just simply acting as an agent, like a travel agent, like a broker? And again, here they've provided more guidance, and essentially the guidance is, do you control key aspects of the goods before they're transferred? Do you have the inventory risk? Do you have pricing discretion? Do you actually have the primary obligation to provide and perform the service? So there's extra guidance now on this. And then finally, if basically you're licensing an intangible asset, if you're licensing an intangible asset, there is guidance as to how you would recognize revenue. Now, if that sounds relatively kind of vague, typically this is things like franchise agreements. If you're a McDonald's, you are licensing the use of that brand, of that logo, of the golden arches. If you charge a fee, if you charge a fee of, I don't know, £1 million for a prime site, when should you recognize that revenue? Is it on the signing of the contract, or is it over the period of the franchise? And again, it would depend on the performance obligations which are embedded in that contract. That's the basic process through. Hopefully by now, most of your clients would have gone through their contractual arrangements and have done the impact assessment. The other thing to appreciate, IFRS 15 does add quite considerable new and far more detailed disclosure requirements. Now, there's some narrative disclosures about how you've identified your performance obligations, what is the point of revenue recognition, if there's contingent elements, but also basically when looking at revenue contract balances, if you've got deferred income, so if you have a contract liability, if you have accrued income, so you actually have a contract asset, how has that asset, how has that liability evolved over the year? How much has been added to the provision? How much has been released to net income? What have been the cash flows arising from that contract? So as we should be doing with liability provisions, basically showing the evolution of the revenue over the reporting period. So I think what we'll probably expect over the next year or so is it will start to emerge what is the expected nature and level of these disclosures. So what is going to form itself into best practice? Okay, that's IFRS 15. I must confess, I used to quite enjoy talking about revenue recognition because there was very little guidance. You could work on basic principles, you could take a view, and it now seems to be there is so much guidance when you're looking at anything. Have I missed something? Now, I was asked the question just yesterday, what kind of industries are going to be most affected by this? Well, certainly things like IT, mobile phone providers, where you're providing a tangible product. I've given the example here. You're providing the handset for a fixed fee. You're providing service alongside that handset. That's the kind of classic multiple deliverable. As I mentioned with franchise, McDonald's, or even if it was like with someone I deal with, he just provides a lock fitting service, and he provides that as a franchise. You have a man in the van who comes around and changes the locks. He charges a fixed fee. You've now got guidance how to recognize that fee. And other things like IT service providers, outsourcing providers, all the people where there are those key elements to their performance. So be prepared. We are going to have to get used to using new, relevant, quite considerable guidance. Okay, apologies for the slight sniffies and distractions. Hopefully it's not distracting you too much, but hopefully it will settle down. Next key standard, this might be for 2019. It might be something you've decided or your clients have decided to tend to immediately. IFRS 16 on leasing or leases. For one of the previous chairman of the IFRS, it was one of his lifetime's ambitions to update the guidance on leasing, and hopefully you're aware he has now fulfilled that ambition, because IFRS 16 is quite a considerable change. Now, just in terms of the overview, comes in from 2019, as I mentioned. You can early adopt, as I mentioned. The biggest impact will be on lease accounting, because for lessees, because there will only be one form of accounting for all leases within scope. So rather than, as we've enjoyed for the last 20 or 30 years, the idea of them being finance or operating leases with a completely different accounting treatment, we are just going to be using one form of accounting, which is basically finance lease accounting. The only thing for lessors is there will have to be increased detail disclosed about the residual value risk of the asset that you are leasing out. So for example, if it is just a motor car, what is the risk that when that car comes back after 4 years, if it is a diesel car and all of the legislation has changed, what is that going to do to its residual value? If it's a Volkswagen and all of the kind of CO2 emissions data has changed, or if it is a building and it is a special purpose building, so you've put in place something which can only really be used as a significant department store for retailers. Well, if no one really needs big department stores, what has happened to its residual? Now, that's really the only impact for lessors. For lessees, it is going to be a much bigger change. So not surprisingly, scope of what we consider a lease is very, very clearly defined. Now, the first thing here is it is defined conceptually rather than just in name. So rather than just saying kind of, okay, well, we'll call the contract a license to occupy or a license to use. If we don't use the lease word, then we'll be fine. No, you won't. It is defined conceptually. There are a few exceptions. And the first block here is where there is already quite detailed IFRS guidance which addresses that particular issue. So things like biological assets, there's already a standard. Oil and gas developments, there's a standard. Everything else, though, if it meets the definition, it will be within scope of IFRS 16. Now, there is at the bottom here a couple of more general exceptions. The first one is if it is just a short-term lease. So if you're on a business trip, you hire a car for a week, it's never going to fall within the scope of IFRS 16. It is just a service. You would account for it as an expense. But if the lease term extends beyond 12 months, then it's IFRS 16. So again, certain people thought we will just design leases to be 364 days long with options to extend. Well, they've thought of that as well. The lease term is defined conceptually. Now, the other one is actually more, to me, of a concern, because what it says is also will be exempted are assets of low value. Now, when I read this, I thought, well, that's strange. Why haven't they used immaterial assets? And the idea was essentially, if you buy for your business, let's say you buy a new light bulb, one of these new LED bulbs, which we're told will last for a quarter of a century, but it only costs you £20. There's no way, even though strictly it is a non-current asset, it is property, plant and equipment, you would just treat it as an expense because it's of low value. So the idea was, this seems to be the same. If you wouldn't capitalize the asset if you bought it for cash, would you really capitalize it just because it's under a lease agreement? So if you're a restaurant and you've given every member of staff a little kind of palm device so they can take orders, if those palm devices only cost £15–20, but you lease them all, so if one breaks, you can hand it back, get a replacement, new for old, would you capitalize them at that price? Now, unfortunately, further guidance was sought on this. What do you mean by low value? And we got then the guidance back, well, actually what we mean is an aggregate spend of, I think it says €5,000. It's either euros or dollars, but that then puts an extra kind of question mark. So if we did buy in our business, if we were a major restaurant chain, like, I see in certain chains like Wagamama's, everyone has their handheld device. If we spent more than €5,000 on those in a year, would we capitalize them? So that's saying if you spent €5,000 on paper clips, would you capitalize them? Of course you wouldn't. So I'm concerned here that this might be one of those areas where regulators are interpreting it differently because it's a lease rather than if it was just an asset. So that, I think we need to watch this space. On leases, in most, it's going to be straightforward. We're looking at a contract which gives you right to control an asset for an identified period, and that period will be more than 12 months. The key test here is control. So obviously, if you sign a lease of a building, it qualifies. If you have a more than 12-month agreement, it's going to be IFRS 16 scope. If you sign a lease of a car, 3 years. If you sign a lease of a photocopier, it's definitely going to be within scope. Now, if you're wondering why the image of the aircraft here, there is a lot of guidance if the form of your lease is slightly less straightforward. So, let's say you buy a train ticket which allows you to travel on a train. Does that give you control of the train? Well, no, it doesn't. You sit wherever you can find. The train company takes you when and how they like, and you hope you get there. If you had a season ticket, would that change things? Well, not really. You're still dependent on them, the train company, being in control. What if your season ticket gave you your own personal seat with your name on it? Well, you have limited control, You have control over who can use that seat, but that's not really the significant control of the train. What about if you had your own little carriage that you could attach when you wanted to the rest of the train? Well, now it's looking like something which maybe gives you more economic control. So there are degrees here. I think it's going to be very sector specific. We'll be looking at maybe things like infrastructure assets, maybe transport related assets, maybe certain IT equipment assets, but it will be again another part of the fine tuning, getting used to this. Now we've got this key limit in mind of 12 months. What do they mean by the lease term? Well, the starting provision, it is the non-cancelable period. So if you're looking at, say, something like a 20-year lease, it's got a maximum length of 20 years, maybe it's over a building. Can it be cancelled within that period? If it can be cancelled, but there is an option to extend, so if there is a classic break clause, you then have to ask the question, how likely is it to be extended? If it's reasonably certain, then you would include that period in the non-cancelable period. If there is an option that the owner of the asset holds to terminate the lease, again, you would ask the question, how likely is the owner, how likely is it that they're going to terminate the lease? Now, if you think it's reasonably certain they will not exercise that option, again, then you exclude, you just ignore the option to terminate. So if you put in a 364-day lease with an annual option to terminate, as a judgment call, you would then have to ask year on year, what is the likelihood of termination? So up to this point, we're just defining, is it IFRS 16? Is it outside the scope of IFRS 16? Step one for most businesses under IFRS will be to actually do this scope assessment. Now, having got this far, accounting is basically, as we've been for years, with a finance lease. On the balance sheet, you will report an asset, which is a new category of asset called a right of use asset. How is that asset valued? It is valued based on the value of the lease liability, which will be, as has always been the case, the net present value of the lease payments discounted using the interest rate implicit in the lease. So again, as we've been doing under the finance lease accounting now for 20, 30 years. There is slightly more guidance here. We've got the guidance on things like if there are variable payments, then you must assess what is the most likely payment that is going to be made under those variable payments, and that will be included in the calculation. Also, if there are lease incentives, so if there's things like a rent-free period on a property, if the landlord contributes to certain of your costs, all of those things are now covered in the guidance. The reported asset must be depreciated, and again, the general expectation is it will be depreciated over the lease term, probably on a straight line basis. Keep it simple. With the lease liability, you will recognize the liability on your balance sheet. In most cases, it will be split between current and non-current because the lease must be more than a year. Any finance charges based on that interest rate, I mean, this is finance lease accounting. You add on the finance charges, report that as a finance charge in net income, and any repayments will then be deducted from the capital value. Bearing in mind, in your cash flow statement, you will report the repayment of the principal as a financing activity. the payment of the interest charges could be either considered financing or operational, depending on how you view the use of this asset. Now, I mean, I've received lots of very practical questions on this, and more will no doubt come through. Questions like, well, if you do have a car lease, if you have a photocopier lease, working out the interest rate implicit is relatively straightforward, because generally under consumer protection law, there will be a quoted rate of interest. How are you meant to do that on something like a commercial property? If you have a 20-year lease of an office block, how are you meant to work out the interest rate? Now, the general thinking seems to be, if you start by looking at things like the rental yield, that will give you a sense of the rate which is implicit, the rate of return in the building. So if the rental value is about £25 a square foot, if to buy it you would pay £250 a square foot, that seems to suggest a yield which is giving a return of about 10% a year. So that's one option. A lot of market data is made available by surveyors, landlord, commercial property agents. A lot of it is available online. You can subscribe to sites which give you details almost on a kind of postal address by postal address basis. A lot of auditors who act for commercial property landlords might already access such information. So that's the first issue. Second issue, I mean, I've used this example already. You sign a 20-year lease and there is that classic 5-year break clause, and that is available every 5 years. So either party can walk away, or have you walked away, have you removed from the building after 5 years, after 10 years, after 15 years. What period would you use? Now, I've mentioned you assess the likelihood of the break clause being exercised. But there's a practical point here. If you have in your business 50 such leases, if you have in your business 100 such leases, are you going to be reassessing them every 5 years? And maybe, I mean, if you decide that, well, it's likely we will leave after 5 years, if you change your mind, you're then going to have to restart all the counting again, recreate a new asset. So the balance sheet could be fluctuating from 1 year to the next as you reassess this. Now, the alternative, which might be just a good practical expedient, is what you essentially do is just presume that for all leases, if you've signed a 20-year lease, the expectation that both you and the landlord are happy for it to run for 20 years. So the starting almost default position would be to use 20 years. Obviously, after 10 years, if you decide to walk away, that would then bring the whole accounting to a close. You would remove the liability, you would remove the asset, and that might be part of a kind of restructuring, a reorganization, a bigger event. Third issue here, in the lease agreement, again, a property lease, the rentals will rise each year in line with inflation, the consumer price index. When would you reflect this change? On the inception point of the lease, you will have to estimate the charges through to the end of the lease, and then each year you will have to revisit those estimates, which potentially means the cash flows will change, which basically means the net present values will change, and you will reload the new values to your asset, to your liability, based on the new estimates each year. And then the final kind of practical point, again, sticking with buildings, which are likely to be one of the biggest areas of change. You're paying $1,200 a month for your rental at the moment. Easy, it's going through P&L. But you also pay a service charge to the management, which covers things like the reception area, cleaning, maybe dealing with security, maybe there's some fire alarm checks, and that costs you £250 a month. What you've now got are two services bundled into one agreement. The building cost is obviously an IFRS 16 cost, the 1,200 it's saying. The 250 is then an expense. It's outside the scope because it's not control of an asset. It's for a security guard to sit there from 6 in the evening till 6 in the morning. And therefore, from the lessee's perspective, it is just an expense. From the lessor's perspective, it is IFRS 15 revenue. But what that also means is the two elements of the payment, the 1,200 and the 250, need to be allocated on a fair value. Which then raises another question. What if you've got a single priced agreement? It's £35 a month, all inclusive. You will then need to divide that into the component parts. So maybe just those few ideas explain why a lot of people are going to be waiting until 2019 to adopt this. One final question. Is IFRS 16 going to have a positive or negative impact on performance measures like EBITDA, the earnings before interest, tax, depreciation, amortization? A number of people have pointed out actually IFRS 16 will be positive because all of the lease costs will be coming out of operating expenses. You'll have amortization of the asset, which is ignored under EBITDA. You have a finance charge on this kind of liability aspect, which again is ignored under EBITDA. So it's not all just bad news and hard work, I hope. Last couple of issues, IFRIC 23. Again, this was largely driven by the Americans. About 10 years ago now, the Americans decided that the basic requirements of reporting your tax provisions based on the enacted tax rate, which is all it says in the standards, that was open to interpretation. Because, yeah, the enacted tax rate is nailed down in law. But that leaves open to interpretation. Well, what income do you include? What expenses do you deduct? Do you just go with what you've put in your tax return? So the Americans have had guidance on this. We're getting it under IFRS from next year. So there was American guidance. There was no IFRS equivalent. When it was proposed there would be an IFRS equivalent, there was, I think, it's fair to say, a degree of concern, with some people saying that the American approach was illogical and inconsistent, or maybe just dangerous, is what they meant. Comes in from next year. The key approach to it is the provision you put in your accounts for your income tax provisions should be valued assuming the tax authorities could and will examine all the information you have available, all the books and records. If they could see everything, all of the evidence supporting transfer pricing for that image right you buy from your sister company, which is based in Luxembourg, all the information supporting that R&D claim you've put in for this new software development. Also, if you look at the third point here, the tax authorities, you value the liability based on what is the most probable outcome. So again, the Americans use the phrase, what is the amount of tax which is more likely than not to be claimed by the tax authorities? So The second point here, the tax authorities will probably accept what is in your tax return. If you think that is more than 50%, you just provide the tax return number. So if you think they'll probably accept your R&D claim, you might have a tax bill in the accounts of 100,000, and that's what's on your tax return. If you think the likelihood is less than 50%, and there are guidance points in the interpretation how you would calculate this, it's even based on the most likely outcome or just on a simple arithmetic mean, the weighted average. What you do is you provide in the accounts what you think is most likely, even though that might be different to what's on your tax return. So you might, on your tax return, be claiming you've only got a tax liability of 100,000, but in your accounts, you've provided 150,000. Now, this is where people said, you may as well wave a flag and invite the authorities to come and have a look at that particular part of your provision. The counter argument to that is, I mean, in the UK, where we have self-assessment, that is what a good corporate company and social company would be doing anyway. You would be putting in the provision you think can be supported. And obviously the authorities, the IFRS authorities, do think there is a good mandate for this standard. And with the big tech companies, the film production companies, going back, we had in the UK things like employment benefit trusts, where we had these tax arrangements which were seen as tax efficient, but they were quite aggressive in terms of whether they were really allowable and deductible. And all it's saying is, if you've entered into such a scheme, then those risks should be more transparent. IFRS 23, sorry, just a final point, it doesn't add any new disclosures, and therefore it is questionable where should these uncertainties be disclosed. I mean, I think obviously the key point is that you would disclose these uncertainties where you do disclose points of management judgment and where there are the key estimation uncertainties. So after the accounting policies, that is the natural place. Okay, it's a 2018 issue. I've left it to last, which is financial instruments, if only because it is a matter of evolution. And actually what I've got are some basic questions which are designed to just illustrate how the new standard will be evolving, where we've been since IS 39 came in, you know, something like for most of us 13 years ago in 2005. The key issues, look at the first one here. You've just got a 5% stake in a private company. It's not a subsidiary, it's not an associate. How must it be valued? Previously, if you couldn't obtain a reliable fair value, you could use cost. Now, you're going to have to use fair value. No choices, no options. You must use fair value. Now, if you are able to support that fair value is still the original cost, there's been no real change, then that would be seen as an acceptable estimate of fair value. It might be a level 3 fair value if it's not supported by any market evidence. So that's the first change. Second one, and I hesitate to enter into this discussion so late in the broadcast. You rent a property in Poland and the rental is set by reference to the exchange rate between the Polish zloty, PLN, and the euro. What is the accounting issue? Well, the accounting issue in 2 words is you have an embedded derivative. You have a currency derivative embedded within a rental agreement. The treatment of embedded derivatives has changed. Things like this, there will be no change. As the currency exchange rate is not economically interrelated, closely related to the rental payments, you would account for the currency derivative separately at fair value. What does change now under IFRS 9 is that if the host contract was something like a bank loan, or if it was something like an investment, a share, you would have to treat the whole of that instrument, which is IFRS 9 scope, at fair value. So this might change the fair values. It's more complicated, but it might do. Third one, you've got a 3-year earn-out agreement on the purchase of a new company. How would you account for the earn-out? Well, as it is payable in 3 years, as it is a liability payable in 3 years, you would account for it at amortized cost. And again, in the treatment of liabilities, generally under IFRS 9, there is no real change, other than if liabilities are actively managed to address and meet assets which are also managed at fair value, you can designate that the liability would also be valued at fair value, which is really just saying if you have a bond that you've issued as a liability and the return on the bond is linked to the return on a portfolio of shares valued at fair value, you can much more easily now just treat and match the both at fair value through P&L. So IFRS 9 is this slightly more management user-friendly standard. Same regard, you've bought a currency forward contract to cover possible losses arising from Brexit, just to cover your costs. And obviously you are doing that as just basic risk management. It's a basic hedging arrangement. IFRS 9 does simplify the rules on hedging. It does make it a lot easier for the management to argue that you're hedging at a portfolio level. Maybe you're using different group companies to achieve the risk management. Maybe you have some euro revenues in one company and you've got some euro expenses in another, and you're just hedging the net difference between the two. So hedging arrangements qualifying for hedge accounting might be more straightforward. The final one, actually for me, is the more troubling. The treatment of bad and doubtful debts. Now, if embedded derivatives, hedging arrangements using currency contracts, if there we're looking at things where kind of treasury experts will be getting involved, so maybe more high-level stuff. The final example here is a bad debt provision. Because what IFRS 9 moves from is is from the old IAS 39, an incurred loss model, where if you actually had loss events on your debtors, your receivables at the year-end date, it moves to an expected loss. At which point I thought, fantastic, this is where I came in as an accountant. Every client, it was a fairly kind of troubling economic time, there was a recession, you would consider putting in a doubtful debt provision for the expected losses, 2% of turnover, just something like that. Now, sadly, IFRS 9 is not going to such a kind of subjective, open framework. What it's going to expect you to do is to quantify the expected losses with some evidence and with some structure to your assessment. So when each receivable is issued, looking at the different classes of receivable, so maybe it supplies to UK retailers, supplies to individuals, cash sales, online sales. Look at each of the stream of receivables and ask the question, what is the chance of default on those receivables? And again, even then, if there is a significant chance of default, what are the expected losses through to the end of the contract? If there is not a significant, but there is some risk of default, what are the expected losses over 12 months? So it is a much more structured approach to dealing with this. And that's the bit we're going to have to contend with at the year end, at the reporting period. Have we got the structures in place? Have we got the evidence? Does the kind of receivables ledger give us the breakdown we need? Just sitting and going through a kind of aged receivables list with someone you know who is suitably kind of realistic about the chances of recovery is no longer going to be acceptable. So the next few slides just give you a bit more background to those changes. The classification and measurement, more based on the management intention, impairment losses on loans, hedge accounting. Those are probably some of the more pervasive issues we'll need to attend to. There's a few other elements here. The new approach for embedded derivatives, things like options within bank loan agreements might become more of an issue. If you do have small amounts of unquoted equity on your balance sheet, the fact you've got to value it at fair value, again, may cause some challenges if you've got some kind of fairly minor strategic investments that you've bought. I would say it's the most pervasive issue, this impairment testing on loans. If you do generally have short-term receivable periods, 30 days, 60 days, other than making sure at your year end, your impairment testing is based on good evidence and it is based on the expected losses you've had in the past on those pools of receivables, then it's going to be a new approach, but it should be manageable. But that's what we need to get used to. Okay, other than that, I am now going to welcome any other questions you might have. Apologies again for being slightly distracting myself by sniffing through this. I hope it hasn't distracted you too much. I'm hoping it's not a kind of allergic reaction to IFRS 15 and 16 and what we're going to have to be contending with over the next couple of years. But those are the highlight main issues and hopefully have pointed you in the right direction. So thanks very much for your attention. Thanks very much for participating today, and the best of luck with all of these new developments. Thank you.